Welcome to the Anton Stentner podcast. And this week we're talking about how Moody's downgraded America's credit and how it's going to shock you what's going to happen to real estate because of it. So, Anton, let's get into it. You should probably explain exactly what Moody's is and why America even has a credit rating and how they downgraded it.
Yeah. So Moody's is one of those credit rating agencies like S&P or like Fitch. The last time we got downgraded, the market went haywire. So in other words, the stock market dropped, interest rates went up. It didn't happen as bad this time. But we're going to break down, like, what does this downgrade mean to us? What does it mean to our wallet? What does it mean to consumers, to debt, to mortgages, investments, and then also to the future? And then this is going to cause, or is causing right now, a lot of people to play defense. And we're going to talk about, like, how you can play offense in regards to it. So as usual, we don't want to give you a lecture. We don't want to tell you, believe this way. We want to tell you some facts. We want to tell you what's going on, what you can do to prepare for it. And to start out, why this is a problem is our national debt right now is $36.22 trillion as of this May. Brother, that is the largest credit card bill known to man. And unfortunately, the debt collectors, our collectors, the people who buy our debt are starting to know it.
We don't have 0% interest on it.
We don't have a 0% balance transfer. And we've got to refinance like $9 trillion worth of debt. So this has already happened previously. And we went from a AAA rating to a AA, 1, which is, A++, but it's not AAA. S&P called us out in 2011. Fitch called us out in 2023. Now, Moody's has officially kicked us off of the AAA pedestal. So kind of insights and overall things that we want to cover during this episode. Why the U.S. Treasury market is not being the safe haven that it once was. What's happening because of this downgrade? In other words, where it's pushing mortgage rates. And spoiler alert, if you haven't seen it, it's pushing mortgage rates over 7. They've been stuck there for the last few days. Now this is creating a gap between the cash buyer, the people with assets, and of course then the first-time home buyer. That gap is now widening. How inflation is then being fueled by the geopolitical events and monetary policy, and how foreign investors are becoming really price sensitive to what we're doing. And as always, we're going to talk about the opportunities this creates for you, our real estate investors, for our subscribers, our business owners that hang out with us.
So what's happening right now with the Moody's downgrade?
Basically, they were saying, hey, you got perfect credit, and you have this like illusion that's happening of fiscal invincibility. And what I mean by that is we are the reserve currency. We're the one that props up the world. And so because Moody's just downgraded us, joining the S&P, joining Fitch, what they said is they were sounding the alarm that the U.S. is on a unsustainable fiscal path right now. That $36 trillion in debt, we have problems coming in key government services, and we're reaching this inflection point because you're seeing things start to get out of control, and we're still spending like drunken sailors. And the tax problems that we're creating on ourselves. Boom, the fiscal deficit and the problem. So the primary concern is by 2035, Moody's is saying that our deficit is going to reach 9% of GDP. It's almost 10% just to pay for our bills. And that's up from 6.4% in 2024. So this is that alarming trend. And all you got to do is go to the Federal Reserve's website. You can go back and look at the 1980s. And you can see federal debt is really low. And then you can see the federal debt start exploding. And then, of course, we hit COVID. It goes up vertically. The problem is we haven't tapered back that spending. What this does is now that we're in this economic uncertainty and treasury rates have risen, this creates a huge burn on our GDP to pay our own bill. So in other words, as the cost of servicing our own debt goes up, the more of our economy that has to go into just servicing our debt, which slows down productivity. So projections indicated that annual interest rates payments could surpass $1.8 trillion by 2035 if we stay on the same road. So when they downgrade us, Benji, what they're doing is they're looking into the future. And they're saying, today you're at a freaking problem. This is an issue. And if you don't fix it and get your house in order, it's going to become a major problem essentially within the next decade. And so realize right now it's representing around 3% of GDP, which is higher than we're spending on defense. We're spending more money to pay our bills than we are to protect the country. That is insane. If interest costs keep coming the way they are and keep staying high because, we've got to pay high rates on the Treasury, that means 18% of federal taxes that we're collecting has to go just to pay for the interest costs. They're also talking about the political polarization. We've seen this really in the last decade. The internet, social media exasperates this issue, but Moody's was talking about how we struggle to achieve consensus when passing a new debt ceiling bill, for example, how we consistently fight over these issues. And that was what was also noted by the S&P and also noted by Fitch when they downgraded us. So we're having a failure of administrations and a failure of Congress. And I blame everyone. I blame the Republicans, the Democrat, the pink fluffy unicorn party. We've got to get this polarization under control because what it does is we're the reserve currency and everyone in the world is looking back at us and they're saying, why are they fighting so much amongst themselves? And if they're fighting so much amongst themselves, that's creating more volatility. That's creating more uncertainty, which means they want a premium to suck up our debt, which is the U.S. Treasury. The problem is that premium makes debt for you more expensive, debt for me more expensive, debt for our subscribers more expensive because Treasuries, specifically the 10-year, affects all consumer debt and all business debt. They don't like it that every time we've got a debt ceiling problem, they're essentially playing chicken. It ends up in the headlines and the global headlines. They feel like the U.S. is losing their sense of who we are. And it's not just about borrowing costs. This is about trust in our monetary system, trust in the bonds. And we've always been the adult in the room. Across the world, hey, we're the reserve currency, but they're going, wait a second. They're throwing fits over there all the time. We might got to put them in timeout. The problem is we have a consumer-based economy. Our consumer-based economy is based on cheap debt. So this leads us into the next point. We're on an unsustainable fiscal path. We talked about it, how projections say that the debt could reach as high as 156% of GDP by 2055. And 134% by 2035. We are on a path where it's growing too fast and the economy isn't growing fast enough. So Lutnick, Trump, Bessent, the whole cabinet, they're talking about, well, we're going to increase GDP. The problem is I don't know if they can increase GDP fast enough to keep us in the global currency status and keep our creditors off of our back and keep China and Saudi Arabia and Japan buying all of our debt. Then we've got these tax policies. So the original Tax and Jobs Cut Act added an estimated $4 trillion in debt due to the lowering of taxes over the next decade. Now, the problem is now we got the big old beautiful tax bill and the big old beautiful one that's already passed the House. According to the CBO, which is the Congressional Budget Office, says that these new proposed tax cuts are going to add another $1 trillion in debt over the same time period. So we're on this unsustainable path. I know DOGE, the Trump administration, we're trying to cut and trim down the government. They're trying to increase GDP, but they've got to increase GDP by literally, they basically almost have to double where we're at. So we got to get GDP up by $1 trillion. We got to cut spending by $1 trillion. We got about a $2 trillion gap that we've got to spread. This is too big of a gap right now.
All right. So I know that one of the big questions people have when they hear America's debt and the number 36 trillion is, how is that even possible, right? Like, how can we have so much debt? And you mentioned it's the most debt. And can you break it down in terms of how much it's costing us? And then why the Moody's credit rating going down will make that even worse?
Yeah. The idea very simply is, we all like visual representations. With the U.S. national debt hitting 36.2 trillion, I need our listeners to understand that's more than the GDP of China, Germany, and Japan all combined. And it's accelerating, and Moody's expects, so this is one of the reasons for the downgrade, that nearly 9% of our budget will be spent on the deficit in the next decade. We can't have that hit between 9 to 10%. It becomes unsustainable. You're also seeing that these interest payments are more than we're spending on defense and education. They're going to outpace that by 2035, coming up to 1.8 trillion. So we're sitting there overfunding our debt and getting nothing for it.
It's like America's getting worse.
America's getting worse. We are the actual consumer caught in the debt spiral with too high of debt. You know, you've got your credit card debt and it's overcharging you. And so you can't make the payments. The problem is the consumer could file bankruptcy. The U.S. cannot file bankruptcy and discharge this debt because we're the reserve currency. One way that we're able to enjoy massively cheap debt is because people come through and they buy our treasuries. So we export our debt to the rest of the world because we're the reserve currency. We literally force feed it to them. And some people are like, this is a bit of a nothing burger. The stock market didn't move that much. But this is the third time it's happened. So when is, too many downgrades too much? What is the tip of the iceberg that you're like, oh my goodness, this is not recoverable?
When does it go from good to fair, right?
Bingo. Yeah. When does it drop so much that all of a sudden, think about it like this. What if instead of being a double A1 or basically like a double A plus, we were just a double A? What if that caused the 10-year treasury to be 1 to 2 points higher for the rest of our lives? And so debt would always be 1 to 2 points higher than what we've experienced in the past.
Well, the simple answer is we would just have less things in our life. We would do less things in our life, and anything we want to do would just be more expensive. So then you'd have to work more to be able to afford it, work more to be able to save to be able to afford it. It would just extend the enjoyment of life to later in life. And that is just kind of like a circle that's continuously destructive.
Yeah.
Because if we're not spending money on those things that we want to do because it costs more money, well, those businesses that would charge for those services, products, or experiences, they have less customers.
Bingo.
So they're not going to do as well.
Yeah.
So then they're not going to hire as many people because they're going to grow slower, or it may be like shrink. You see, like
this becomes the economic death spiral. And you're talking about the consumer side. I want you to think about the business side. The largest capital market in the world is the United States. This is the largest, most liquid capital market. If our credit rating goes down, all of a sudden we become the not coolest place to put your money. And all the foreign investors aren't coming here. And everyone's not immigrating here because of all the jobs, because of the opportunity. That's when the wheels fall off, because we're already having the wheels start to fall off because of our aging population and the entitlement programs, aka Medicare, Medicaid, Social Security, retirement plans. Those are getting so big that we have to keep importing people because we're not having enough babies to keep paying for that stuff. So what's really interesting, Benji, when you start to look at this then is, well, who is buying our debt? Okay, everyone saw it in the news. China's not buying as much of our debt. Surprise, surprise. You get in a little tariff war, people get pissed off, they sell some of your debt. But who is buying it? So we've had this over-exuberant privilege of being the reserve currency. And the escalating debt, it looks like it's an abstract problem, but it's actually, it's pretty clear. We have a spending problem. We have to get our spending under control. And we've got to pay down some of this debt. And that foreign demand for treasuries, aka other countries and other buyers and sovereign wealth funds, is slowing. And this is why you can get decent yields in the United States, but you're seeing yields everywhere else like Japan and Germany coming down. So we're still paying high yields because we have to. So who's buying it? Well, we know that China is currently buying less. And that all of a sudden we're getting a much more notable reliance on these foreign sovereign wealth funds, especially
in the Middle East.
Nailed it. Especially the Gulf nations like Qatar and Saudi Arabia. So they've been picking up the slack. And then you go and you kind of dig through this. I do a lot of research when we're looking at these podcasts. So Secretary Bessent just said about the Moody's downgrade. Who cares? Qatar doesn't care. Saudi doesn't care. I'm sorry, brother. That's not a vote of confidence in my book, because what happens if a conflict breaks out and all of a sudden they're not our good trading partners?
It's like you're you have a gambling debt, right?
Yeah.
And then you can't go to your credit cards anymore. Your bank won't lend to you. You've tapped your home equity line of credit. So now you have to go to the mob and get like a like hard money loan,
yeah,
right?
Exactly.
But this is like real hard money. So like it's funny because, by the way, I think it was a great trip. Optics were good, but yeah, like they play by their own rules, just like that example of
That's like a whole nother episode. I think Trump killed it over there and did phenomenal things for the U.S. But I don't want to let once again, I want to show facts. The facts is the Middle East is picking up more of our debt than they were before. So this isn't just finance, it's now geopolitics. And
there's a reason we didn't go tap them for funds for a long time. And we went to countries like China and Japan in Europe, China, not really, but those other ones are allies.
Yes.
Because that's a sound money from a legit place. No questions, and they're democracies, right? Versus over there, probably not a democracy. I'm assuming
not a democracy, but making massive strides in improving. And Trump did say that in his speech, and I really agree with that. What's also interesting, so you flip this over, and then we come back to our in-house. We start looking at our own Federal Reserve. Well, the Federal Reserve is kind of also starting to, fragment and end up on multiple different sides of the coin. So Williams was saying our confidence is intact, and Kashikari was saying, it's a little more uncertain. And so there's a lack of consensus in our own Federal Reserve about what to be doing with monetary policy. The thing I want people to get is we're in this uncharted territory where you've got rising inflation, you've got a slowing economy, which is, unfortunately, that's a recipe for stagflation. We've talked about that on previous episodes. You have rising interest rate costs, and we have out-of-control debt in the face of tax cuts. Long term, these tax cuts may be great. Today, they're creating issues, though. And so we just went from the high level, right?
Yeah, can I ask you this question?
Yeah, go ahead.
Yeah, so I think what everyone's asking, though, is how does the Moody's credit rating lowering America's credit affect the average consumer, especially home buyers, sellers, and investors?
Yeah, 100%. The average consumer, because Moody's lowers our credit rating, just means that everything now costs them a little bit more. All consumer debt, like I've mentioned before, is based on the 10-year Treasury. And this caused the 10-year Treasury to rise. Just look at it over the last week. It's almost back to the 6-month highs right now. You saw mortgage debt go back to 7%. And you've now seen credit card rates go up. You saw auto loan rates go up. You see lines of credit for business go up. So it's all increasing the borrowing cost to both the consumer and the business. And Preston Cherry from Charles Schwab said it really well. He said, higher government debt means higher rates, making it harder for people to grow their financial foundation. This is where policy meets the paycheck. And he's saying it like meets the paycheck. This is where policy like T-boned the paycheck, where it's getting a little bit out of control. So cause mortgage rates to hit 7. They're staying higher. I'm going to argue right now, we are now in a higher for longer period. Okay. I thought rates would already be coming down and didn't anticipate due to the stickiness of inflation and due to the geopolitical conflicts and the buying of our debt and the tariff wars that this would keep rates this high. As rates stay high, the market starts to just slow down and completely bifurcate. Above 6.5, as it approaches 7, buyers stop purchasing. So if you go and look at mortgage demand, aka mortgage applications for this week, do you think they're up or down?
Down.
They're down because rates are higher. So you already see that mortgage demand. And of course, that'll show up in active inventory growing. It'll show up in less pendings. So that bifurcated market, what I mean by that is it's the difference between the haves and the have-nots. People with assets are purchasing real estate and they are getting deals. And people with cash, that cash buyer versus that first-time home buyer, this is hurting that first-time home buyer, the middle class and below, more than it hurts the upper middle class. So if you have cash and assets, you're fine. If you don't and you're buying with a loan, I mean, they just walked up and straight punched you in the mouth and said, "Eat it, sucker." And this also further exasperates the lock-in effect. See, what was happening as rates were getting towards 6 again, you were starting to see some of the people start to peel off. The lock-in effect is because a majority of the mortgages out there are below 4%, so they can't afford to trade in. It's not economically feasible for them to move into the next property. So we're selling the same amount of homes right now we did in the Seattle metro back at the end of the great financial crisis and across the United States as we did in 1995. We're about 50% off of peak. That's going to continue. And the problem, and this is my major concern right here. The rest of this is of concern. This is the big one. Inflation, for lack of a better word, is mutating. It's changing, and it's changing in front of our eyes, because when we looked at the previous CPI data and we were talking about what was happening, all the data was trending in a downward direction, which means rates should be trending down and the Fed should be getting closer to cutting. However, all of a sudden you have Liberation Day and you have crazy tariffs that are introduced. Those crazy tariffs introduced this item that the economy wasn't ready for. And as it introduced that probably caused the last report to come out just slightly higher. In other words, the inflation is already starting to show up, which is going to prevent the Fed from cutting rates while the unemployment rate is rising, while the number of job openings is declining, while the number of people quitting one job and moving to another is declining, and some of these tech companies are talking about layoffs, while we're in the process of AIing everything, of automating everything. There's these humanoid robots working in a BMW factory. At what point do we start losing jobs to AI and the machines? So you have inflation moving to different places and becoming different than it was before. Plus, and lastly, you still have geopolitical tensions out there. The war in Ukraine is not solved. Thank goodness, Pakistan and India, they came to a ceasefire, but we've got to get this stuff put behind us. I feel as though we may have passed peak uncertainty, but then when this happens, it pops its head back up. It's like we can't quite get there. The waves are still crashing over us, and we're slowly drowning, or death by 1,000 cuts of the U.S. economy and the U.S. consumer, because the consumer's running out of money. Credit, just debt in general, is still rising at a rapid rate, and student loans are defaulting at a higher rate. So the consumer is beat up. We need some relief from this. We need some certainty. As certainty enters the market, we will see rates come down. Until then, we're in just uncharted territories.
All right, so this is a lot, and it sounds kind of scary. Basically, what I'm hearing from you is everything's going to be more expensive. Real estate is going to get tough.
Yeah.
You're going to have to work harder, make more money, and rinse and repeat. So then what are the opportunities right now for investors to not necessarily take advantage, but how do they strategize so that they can continue investing in real estate and, planting seeds for ROI?
What I want everyone to be thinking about is when we have massive uncertainty, the other side of that same coin is massive opportunity. And during the chaos, there's always calm in the middle of that storm. And what happens is fear starts to peak that's when you should be thinking, how do I buy? So we went and looked through specifically and came up with multiple what we believe are opportunities right now. This is for the home buyer. This is for the investor. This is for the builder, the developer. Creative financing is back in vogue. Brother man, I've done more creative financing in the last 24 months than I have in the last decade. I've been getting owner financing. I've been getting private debt. We've been getting debt from people's IRAs. We've had investors sell properties and turn around and give us the cash as debt. Why? They say, I'm tired of tenants, toilets, and hot water tanks. And I just want to make a return without the tenants, the toilets, and the hot water tanks and the turmoil. And it's really interesting. This is the first time in my life I've seen this much of that happen. And with Washington State, we just passed the rent control bill. I expect us to see more of this happening. So I'm talking seller financing. I'm talking subject to deals. I'm talking wrapping of mortgages. I'm talking private money. I'm talking hard money. I'm talking money against out of people's IRAs and against their portfolios. So you have an opportunity to build a portfolio when the competition is sitting around waiting on the rates. Build to rent, BTR. Number 2, it's booming. Build to rent is where you do a subdivision and you go in and build single family homes and rent out the whole subdivision. That could be 5 homes. It could be 100. People want to live in a home. Not everyone wants to live in an apartment. Not everyone wants to live in a townhome. These BTR communities are outpacing inflation because a single-family home is so hard to create right now. I believe BTR for certain investors is going to be the future. You're seeing a lot of this, of course, happen across, the Midwest and the South, but we're doing BTR here in Seattle too. That lots of opportunities. So this is investors and developers creating small communities with just purpose-built single-family homes. And because that single-family home is out appreciating other asset classes, that's where you're going to win. With rates high, cash flow is going to suck. Opportunity to partner with builders, opportunity to partner with developers, opportunities to do syndications, opportunities to create rental stock where rents are low. Okay, small multifamily. Small multifamily is going to be more resilient to these higher rates. It's going to be easier to deal with than a 100 or a 200 unit complex. Also, your 2, 3, and 4 unit properties are not commercial debt. So they're easier to qualify for, easier to finance. Plus, in that big old tax bill, bonus depreciation is already approved by the House. Bonus depreciation looks like it's going to get approved by the Senate. So we got 100% bonus depreciation coming back for 5 years, retroactive, starting in January. Game on like Donkey Kong. We've recorded other videos about this one on how you can pay 0 in taxes using this strategy. Phenomenal. Can't wait. I believe you're going to see the long-term multifamily rebound. The long-term multifamily rebound is probably not going to start, though, until 2026. Rates are really high. In 2022, the Federal Reserve hiked us 500 points, or 5%, and that caused these large multifamily developments to slow down. They take about 3 years to hit. So you're finishing up your last one. So you have a hole missing in large multifamily developments that's going to start late 25 and definitely in 2026, which is going to cause rents to artificially rise. So your opportunity is that market is cold. Find them, buy them, build them, stabilize them, refinance them, whatever. Alternative and affordable housing solutions. This is a major issue across the Seattle Metro and a lot of the United States. I'm talking modular housing, micro units, co-living, converted apartments, converted office complex, prefabs. And in Washington, I'm talking about middle housing, ADUs and DADUs. ADUs and DADUs are one of your greatest plays here in Washington State. So massive opportunity to create these and look for holes or opportunities in zoning or to tap into equity to be able to do this. Next one, buy land strategically. I'm talking about land that is in areas that you can rezone. It's part of the comprehensive plan that's going to be changed in the future. It's on the edge of commercial. It's on the edge of residential. It's going to become multifamily. It's going to become commercial. Also be thinking about how AI is going to cause a massive spike in demand for energy. Is there land that you could strategically purchase that is going to be near like in Eastern Washington, for example? It's closer to the hydroelectric dam, so you're going to get cheaper power. It's closer to a solar farm, cheaper power. Something just to be really thinking about. We need multiple terawatts of power to keep up with AI in the next 5 to 10 years. It's going to become a major issue, lots of money to be made there. Really weird to even say this one. Short-term rentals. So short-term rentals have been getting their butt kicked, just destroyed. Well, when something's getting destroyed, be thinking, well, where's the opportunity? The opportunity is, if you look right now, and a lot of airlines just reported their earnings. People are flying less. Okay, pattern. Let's look for the bigger pattern. What are they doing? They're going to vacation within 1 to 5 hours of their home. All right, we live in Seattle. Cool. Where is that? That's Chelan, Suncadia, that's up in Whistler. Where could you buy a short-term rental that's a destination that's drivable from a major metro that has low unemployment, that is a destination that has good reviews, that's already existing, but managed improperly, that's not performing well? Go buy it, turn it around, move it to the next level. I think that's going to be a good opportunity. Workforce housing, transitional housing. I'm talking seniors, I'm talking veterans, I'm talking low-income families, I'm talking people coming out of alcohol treatment, coming out of prison, college students. We need more of this. I put one of my duplexes up for rent here in the last few months. It's 1 bedroom, 1 bath. It's decent, but it's nothing like, oh my goodness, this is special. It's got no garage, and it's not in the best part of town. 30 applications. Why? It's filling this need. We don't have enough of the need being filled for this type of transitional or small housing. Last but not least, I believe you're going to continue to see commercial conversions. These commercial conversions are like when you see the mall and all of a sudden they rip the Sears out and they shove the stack of multifamily in there, and then they put the Dave & Buster's on the bottom, where they're changing things and making them more of a destination, where you're converting an office complex into something else, where you're tearing it down and maybe now using it for storage or a warehouse facility. Commercial conversions of improperly used or outdated stuff is going to be a massive opportunity. So, final takeaway. We are in massively uncertain times. And I felt like we had passed peak uncertainty, and then Moody came and punched us in the kisser. And this is causing the cost of debt to rise for a moment in time. We just talked about the opportunities, but we're going to be living in a higher rate world for a bit longer. You have to negotiate better deals. You have to negotiate better terms. You've got to put more cash on the sideline. But realize, what is a phenomenal hedge against inflation? Real estate. So we will continue to be putting our money into real estate. We are cautiously optimistic. If you guys have specific questions about projects in the Seattle Metro, we'd love to chat with you about them. Or if you're an investor or a home buyer across the U.S., love to hook you up with someone in your area that could help with these things. I'm Anton Stetner. Thanks for listening.